So in this video, I'm going to be covering sort of a more complex example surrounding stocks, bonds, basically essentially their prices and their relationships with yields. So this is actually one of the questions from one of the homework assignments and actually one that was tested on one of the previous midterms. It's a fairly challenging one, so I just thought I'd go over it as it's one of the questions that students mostly struggle with. So let's say you have two companies, company A and company B. Let's say they have their stocks equity. The yield on company A stock is 4.2%, while on company B is 4.6%. As you can see, the sort of yield spread is the term given to the difference between the two yields, which is quite simply given, it's 0.04%. Now here's the question. Historically, this is right now, the yield spread is 0.04%, which is the difference between the two. Historically, it was 1%. The difference between the two actually used to be 1%. Now, if we expect that it will go back to 1%, that the difference but right now is 0.04, it will go back to 1%, and that the midpoint of the difference will stay exactly the same, which stock would you buy and which stock would you sell? Now at this point I would urge you to pause the video before I actually cover the solution, so you have a better chance of sort of understanding how to approach these questions. So essentially, the first step to this question is actually finding out which yield will rise and which yield will fall. In the question, I specifically said that the midpoint of the yield is going to stay exactly the same. So, what's the midpoint between 4.2 and 4.6? That's basically taking the average of the two numbers, which is 4.4, the number that's exactly halfway between these two numbers. Now, right now, the spread is 0.04, and it's going to go back to 1%. So the difference between the yield prices is going to spread apart even more. So the lower one is going to go lower, and the higher one is going to go higher. So they're going to spread out by exactly what specific amount I can show you, but that's not really relevant to the question here. So the midpoint is 4.4 with a difference of 0.02 to each of them. Now, if the difference has to be 1%, each of the difference between the middle and the two yields has to be 0.5% each, so that the difference between the yields themselves is 1%. So this 4.6 yield will go up, this 4.2 yield will go down. Now here comes the tricky part. We know from a property studied in class that as yields fall, prices rise. And on the other hand, if yields rise, prices fall. So clearly, if this is 4.2%, in order to get the sort of equilibrium, the rate of 1%, this price is going to fall. So that means this yield is going to fall, So the price of this stock will go up. So stock price going up. This, on the other hand, this yield is going to go up. So the price will go down. Now, if you know that the price is going to go up, you would obviously want to buy the stock. You would buy it now, the price would go up, you would sell it later for a profit. On the other hand, for company B, the price is going to go down. And this is something you should have learned in first year. You should actually short sell the stock, which is basically the idea of selling high and buying low. So the answer to this question is first figuring out what the sort of midpoint is, seeing which yield will rise, which will fall, and profiting off that using the fact that as yields rise, prices fall, and vice versa. So, like I said, the yield of the company A will fall, prices will rise, you should buy that stock. The yield of company B will rise, so the price will fall, you should short sell that stock. So, this was one of the more complex examples. If you want me to cover more of these, please do leave it down in the comment section below, because these questions usually tend to appear on midterms, exams, and finals, and it's really helpful for students to study these. And if you have a really good understanding of this at this point, you really shouldn't be worried about anything at all. So, this was one of the more complex examples.